Hey traders, Jason here from Lever Brothers. So in this video I'm going to talk a little bit about group strength. The idea being that whatever the market does, if group strength is good, then the market's probably going to be in good shape, and if group strength isn't very good, then the market's probably not going to be in good shape. The idea being that if the right groups are leading, if leadership stocks are leading, if leadership groups are leading, then the market's going to follow, okay? Because a lot of times we get caught in the trap of just looking at the S&P 500, but if we look beneath the surface and we see what groups are leading, the group strength, the leaderboard among the groups could tell us what's going on beneath the surface, and that gives us a hint of what's brewing and what's likely to take place going forward. So I'm going to look at some group strength here. First, let's look at the S&P just to kind of give you an overview of where things stand. So this is the S&P since early December. So the drop from here down to here was about 25%. Okay, very normal bear market. 25% drops, not a big deal. It's a very normal bear market, no problem at all. This rally here recaptured a little bit more than 50% of the drops. That's a decent bounce. And this tends to lead to the end of a bear market. In fact, the stats say that when the market recaptures 50% of the drop, that a low is in place. Then this drop here gave back 62% of this previous rally. Okay, a little bit more than you want, but not horrible. Then this bounce recaptured, again, 50% of the drop. And then this drop here recaptured 62% of the previous rally. So I know that's a little bit confusing. This rally here recaptured a little bit more than 50% of the drop, and this rally here recaptured about 50% of the drop. But this drop gave back about 62% of the rally, and this drop, which is one single day today, gave back 62% of the previous rally. So the rallies are only getting back about 50% of the previous drop, and then the sell-offs that follow are going much further. So the net of all this is we have a downtrend. There's no question about that. If I were to draw some sort of linear regression line, it'd probably be somewhere in there. Okay, there's no question at the market that the trend is down, even though this rally here in July and August went pretty far. There's no question that lower highs, lower lows are in place, and the trend is down overall. Okay, but this rally here is a little bit attractive. Okay, we rallied more than 5% in 4 days, and all 4 of those days were up days. So according to Ryan Dietrich, okay, he posted this on Twitter. He said the market just rallied more than 5% in 4 days, with each day being green. Looking out 1 year, the market has been up 86.1% of the time, with a median gain of 19.4%. And of course, the key number here is 1 year. Okay, so even though these gains, even though the market's up 86% of the time with a median gain of 19.4%, that's looking out 1 year. So that's a long time from now. The market could easily go up a lot, down a lot, move sideways. It could do a lot of things in the next year. You can't just buy the S&P and sit back and say, hey, I got an 86% chance of making about 20% over the next year. You can't do that, because you could be sitting in a 20-30% loss before that happens, okay? But looking out into the future, that's what history says, and we already know that the market tends to do well after bottoming during a midterm election year. This is a midterm election year, election coming up in less than 2 months. The market tends to be weak during a midterm year, and then it does incredibly well for the 1 year and 2 year following the midterm year low. So there's a couple different quant studies that point towards the market doing well looking out a year or 2 from now, but that doesn't help us when looking out a month, 2 months, or 6 months, okay? So I'm going to look at some group strength here to maybe help tell us what's going on in the near term. First, this is something I posted yesterday on Twitter. You can see this is how I see things. The market needs to rest. I'm doing this after, basically yesterday morning when the market was doing really well. I said the market needs to rest. If the rest is minor and does little damage, we're good for another leg up. But if the rest pulls back, quote unquote, too much, it's back to the drawing board. So I was essentially saying we had a nice run off the low just in the last week. Things looking good. Shorts blown out of the, blown away. Lots of short covering, some good gains, some stocks setting up for some continuation moves. The vibe is a little bit more positive. And if we could rest and pull back a little bit, that'd be great. We're going to probably leg up again. But if the rest pulls back too much, then all bets are off. And like today's drop is huge. The S&P is down more than 100 points. The NASDAQ on a percentage basis is down even more. So today's drop actually does qualify for quote unquote too much. So whatever good vibes got built up over the last week are now gone. So let's back up before I look at the group charts. Here's the S&P going back 2 years. So it looks like, and I'm just going to kind of box this in a little bit. This to me is kind of like an important line. So I view it as we have this top forming. Okay, you can see move up, generally move up, come down, move up, lower high, and then comes down, breaks down from that top, comes back down, or comes back up, gets rejected, and then continues on from there. So let me delete some of these. So I view it as that's a box, and now we have another possible box forming. And this reminds me of 2007, 2008, because back then in July of 2007, the S&P traded at a level, and 13 months later in August of 2008, the S&P was only down 100 points. Okay, so even though the greatest financial crisis since the Great Depression was playing out, the S&P was only down 100 points over the course of 13 months. Now, on a percentage basis, it's more than 100 points now, because back then the S&P was trading at like 1,300, 1,400, somewhere around there. So on a percentage basis, that would be like 250 points today. And that reminds me of, and the reason why this reminds me of that is because like even right now with the S&P trading at about 4,000, you can go all the way back to a year ago, October, where the S&P was trading at 4,300. So here we are, like almost a year later, and the S&P is only, percentage basis is only down, isn't down that much. It's down less than 10%. Okay, this is the nature of a top. Tops take a long time to form. They get drawn out over many months, oftentimes 1 to 2 years. People get lulled into believing that, like, hey, the market goes up, the market goes down. We're just in consolidation mode, and then all at once, the market can completely fall apart. Not predicting that's going to happen right now. I do think things are going to get worse, but I'm just pointing out that it's fairly normal for us to look back and say, hey, the market's only down 8-10% over the last year. That's not that bad. That's pretty normal. As you can see from the chart here, market traded in a big top, then it broke down. Now it's trading in another range. All right, so let's look at some of the groups. Specifically just over the last couple of weeks. So we've had this nice bounce here. If the right groups are leading, if tech is leading, if home construction is leading, if consumer type groups are leading, then that would give me some confidence that the market is, the economy is doing well and the market's gaining some strength. But if the wrong groups are leading, if defensive groups are leading, then that would be a bad sign. So let's look at a few here. All right, so here are the top 15 groups based on how far a group is above its 10-day moving average. So what we notice here is we have silver's number 1, we have copper, industrial metals, aluminum, gold. Oops. So five of the top 15 groups are, they're commodity groups. Then you have pollution, which is certainly not a growth stock. You have, shipping and ports is pretty, it's nice that they're leading, but they're backed up forever. It's good that leisure and resorts and casinos are leading. So that's actually a decent sign, but I don't see any software here. I don't see any semiconductors here. I see mostly commodities and like safe haven type groups, medical devices, insurance, and such. So here are the weakest groups based on how far a group is above its 10-day moving average. So you have auto and truck dealerships, which is certainly consumer facing, residential construction's consumer facing, home improvement stores consumer facing. You got semiconductors, and then you got another semiconductor group down here. Then you got internet content and information, which is going to be tech. electronic and computer distribution, which is going to be tech related. So this is the loser board, and you have a lot of the losers are consumer facing, like home building, cars, trucks, and tech, such as semiconductors, internet stuff. So between these two groups, you have commodities leading and tech and consumer facing stuff lagging. All right, let's look at another list. All right, so here are the top 10 groups based on their performance over the last 10 days. So it takes today's print and it compares it to what it was 10 days ago. So it just gives us an idea of what's doing well in the near term. So solar's doing well. We know that. But otherwise, you have medical devices, medical care, medical instruments. You have diagnostics and research. So there's a lot of medical stuff here. We have apparel stores, department stores, and discount stores. So something's going on there with with brick and mortar stores. Not over, which is good. It's good to see some consumer facing groups on this board, but a lot of medical stuff, more insurance, airports type stuff. Waste management is certainly not a leadership type group. Utility is not a leadership group. Pollution and control is not a leadership group. So it's like the stocks that are leading, the groups that are leading aren't the ones that you want to see leading. Now, what are the weakest groups based on the performance over the last 10 days? Again, auto and truck dealerships, semiconductors, computer systems, residential construction, another semiconductor group. So a lot of stuff that's consumer facing. So overall, you have the market just rallied more than 5% in 4 days, which suggests high odds of the market doing well a year from now. But in the near term, I would argue that the wrong groups are leading. Semiconductors are at the bottom of the list. Like the list I just showed you was not just the laggards. They're the ones that are like literally at the bottom of the list. Out of 160 groups, semiconductors are at the bottom. So no semiconductors among the leaders, no software among the leaders, no tech among the leaders. Instead, you have commodities and just like safe havens, like medical devices and such. So that's not very encouraging. In order for the market to do well, we need more tech. We need more, we need more consumer-facing stuff like cars, trucks, houses. So in my eyes, best case scenario right now is the market just kind of moves up and down in a range. If it can move up and down in a range for 6 months, I'd consider that to be very good. And of course, worst case scenario is the market's going to just head south from here. Okay, the market's going down right now pretty hard. Inflation remains. Okay, it's not transitory. It's going to remain in place. The Fed's going to keep raising rates. And so, best case scenario is the market goes sideways and does nothing. Worst case scenario is it's going to continue lower. And I get this from the group strength. Like the wrong groups are leading the market higher, and that's not a good foundation to build from. All right, good luck. See you next time.